class. Okay, let's go. Question 2A. This is on impairment of assets. So let's see how it goes. A division IMPC has the following non-current assets, which are stated at their carrying values at 31st December 2018. So we have goodwill, we have property, plant and equipment divided into land and building 320, and then plant and machinery 310, making 430. So the total carrying value of the cash generating unit or the total asset is $500 million. Because these assets are used to produce a specific product, it is possible to identify the cash flows arising from their use. The management of IMPC believes that the value of these assets may have become impaired because a major competitor has developed a superior version of the same product, and as a result, sales are expected to fall. The following additional information is relevant. Forecast cash flows arising from the use of the assets are given below from 31st December 2019, 2020, and 2021. I. The directors are of the opinion that the market would expect a pre-tax return of 12% of an investment in an equity that manufactures a product of this type. II. The land and building are carried at valuation. So there, this is where we are. The surplus relating to the revaluation of land and building that remains in the revaluation reserve at 31st December 2018 was what? $65 million. So that's a key thing. All other current assets are carried at historical cost. What does it mean? It means that the land and building are carried at a revalued amount, and that land and building has a surplus built up of $65 million. III. Goodwill does not have any market value. Now, we don't need to be told this. Even if the examiner doesn't tell us, we should know this. It is estimated that the land and building could be sold for $270 million, and the plant and machinery could be sold for $50 million net of selling cost. Required. I. Calculate the impairment loss that will be recognized in the accounts of IMPC, and then II. Explain how this loss will be treated in the financial statements for the year ended 31st December 2018. Right. So this is according to IAS 36, impairment of assets. And in according to IAS 36, we say that an asset is said to have suffered an impairment when the carrying value of the asset is greater than the recoverable amount. And we also said that recoverable amount is the higher of EBAZE, the value in use, and then fair value less cost to sell. So having had this at the back of our mind, we know that the carrying value of the cash generating unit has been given to us as $500 million. So this is where the analogy you missed without including the goodwill. So the carrying value of the cash generating unit, so cash generating unit is the $500 million. But we need to get a recoverable amount, which is the value in use and then fair value less cost to sell. So first, fair value less cost to sell, we are told that the land and building could be sold for how much? Could be sold for how much? $270. And then the plant and machinery could be sold for $50 million, giving us a total of $320 million. So this is the fair value less cost to sell. Then we need to calculate the value in use for the cash generating unit. Remember, we are given a pre-tax rate of 12%, so that is what we use as a discount factor. It's always supposed to be pre-tax. It's always supposed to be pre-tax. So we have the year here, 2019, 2020, 2021.
And pre-finance cost. Pre-finance cost.
I don't understand your statement.
Sorry.
Oh, okay. It's different from this. Oh, okay. Pre-finance cost is in relation to what?
Like, it's not really matter.
It's not really matter. Why do you thought baby home? Why do you thought baby different from her?
I was looking at the cash flow. So they say it should be pre-tax cash flow, right?
Yeah.
So pre-tax finance, like
Yeah, it's the
Cash
same
flow.
statement here.
Cash flow
Because
that is-
who say, the directors are of the opinion that the market will expect a pre-tax return on an investment in an equity. So it's the same thing. It's the same statement. The pre-tax rate of providing finance or if you invest in is the same thing. So discount factor at 12%. Now, if you don't know, you apply this formula, right? So when you did it, what did you get?
0.893.
0.893, 798. So now did you get the same thing? You what it? So give me answers.
165.
165, 128, 93. Total 386. So this is the value in use. Value in use. So if you compare, recoverable amount is the higher of value in use and fair value less cost to sell. So if you see, value in use is 320. Fair value less cost to sell is 320. Value in use is what? 386. So what do? What is the recoverable amount? The recoverable amount will be equal to what? The value in use, which is what? The 386 million. Okay. So that is the I aspect of the question. They said we should calculate the impairment loss that will be recognized. So that's the first thing, the impairment loss. Hey, we are not candidates. So impairment loss will now be the carrying value minus the recoverable amount. And that will be the carrying value of 500 million and the recoverable amount of 386 million. And so that will give us 114 million. So this is the impairment loss. So that is the I aspect of the question, the impairment loss. Now in some questions, the examiner will still say, calculate the impairment loss that will be generated. But maybe you realize that the asset has not suffered impairment. So you just have to be on the lookout for on such statements.
Again.
So that means it's a revaluation gain actually. It's not loss. So there you just say that there is no loss. Hence you don't go ahead with the B aspect at all. Do you get the idea? Next one, II. How the loss should be treated. So we will deal with allocation of the impairment loss. What is the principle? What is the principle?
Right of goodwill.
Right of goodwill. Then we prorate, right? Okay, so cash generating units before. Then we put impairment in the middle. Then we get cash generating units after impairment. So we got goodwill of 70. What else? Land and building. How much is it?
110.
110.
Sorry, 320.
320.
Plant is 110.
So plant and machinery. Let's go. This gives us the 500. So we are having a recoverable amount of 386. And so that leads us to an impairment of 114. So we allocate. So 70 will go. Hence there will be nothing there for goodwill. Then we now prorate. So when we are sharing, what's the figure left? This minus this. 44. So we are left with 44. This 44 will be shared between these two guys. So we will say this plus this will give us 430. So 320 over 430 times 44. What do we have? 11. Then that will give us 99. Hey, you sure?
Sorry. That should give us 33.
This should be 33.
Yes.
So this will give us
287.
287. Then this will be 110 over 450 times 44. And that will be 11. And so 99. Okay. something I told you when we were solving a question on impairment also. The recoverable amount of the asset should not be more than what? The fair value less cost to sell. So I was just looking at that. I was just looking at that as well in relation to that. So that's
so getting the value you use shouldn't be more than the
getting what?
The value you shouldn't be more than the fair value.
Getting the
What you just said.
no, what I just said was that, for instance, the values here, okay, in relation to the plant and machinery, at the end of the day, shouldn't be more than what? The fair value less cost to sell. But if you check in this case, it's more.
Yeah.
But we are not required to further go about that. But what we would have done is that we will still carry this guy at what? The 50. Now the ACCA, the Rebecca, way more. Okay, this is 270.
And that one is.
This one too is more.
Yeah, almost.
So
No, what is this? This is the disposal value, right? No. This shouldn't be more than this, rather. Like when you finish with this shouldn't be more than this.
The fair value shouldn't
The fair value less cost to sell shouldn't be more than the recoverable amount. So I think we solved a question like that. I don't know if you remember. Is this here? It should be here.
It's not yet.
It should be here. Now, when we are saying who we are here, because the examiner said, how will this be treated in the financial statement? So remember, when we were reading the question, we were told that the land and building has a surplus of how much? $65 million. Entity. If an asset already has a surplus of $65 million, then in the following year it is suffering an impairment, we will just reduce the surplus with what? That impairment. In other words, the impairment loss, and this is what you write, the impairment loss in relation to the land and building of the $33 million will be settled in what? Or be treated in equity. In equity as a reduction to the revaluation surplus. That's it. That's it. So you treat that in equity as a reduction to the revaluation surplus. Then, what does that mean then? It means you recognize 70 plus 11, which is what? 81 million in what? The income statement. That's it.
That's an expense.
Yeah?
Right. Otherwise.
That's an impairment loss. Media, what we need for the definition. Impairment loss is an expense, right? Loss is an expense. Obi him. Okay, so that's the question one. That's the I aspect. That's what you're supposed to do for 5 marks. It looks bulky, but give you your work. Allocation of impairment loss. Darling, you're running away. See, for the web. Okay, let's go. B. AZ, a public limited company, operates in the global markets. I. During the year, the company decided to discontinue its holiday business as a result of competition in the sector. This plan had been approved by the board of directors and announced in the press. Required. Discuss the implication of each of the above points. Now there is II there, I'll come back to that. For the determination of the segmental information required to be prepared and disclosed under IFRS 8 operating segment and other relevant accounting standards. Okay, so what do you say? What do you say? Now, the company has decided to discontinue its what? Holiday business. Alright? In the sector. Now, so we have to go back to IFRS 5, discontinued what? Operation. And ask ourselves, what is the recognition criteria for a discontinued operation? The sale. So what do we say? Intention to sell the asset, right? The asset should be available. We should locate a buyer, and we should expect that it should be what? Sold within the 12th accounting year. If you check for this segment of their business, yes, they have an intention to sell, but is it available? They have announced it in the press. But have they located a buyer? Do they expect to sell it within the next accounting year? So how do we answer this question? Derek, what did you write?
You are saying that they've not met the condition. Now they are also asking us to disclose whether it meets the disclosure requirement for IFRS 8. So this one, because they can't meet, they have not met the disclosure requirement for discontinued operation.
Yeah.
They can't disclose this, the holiday business as a discontinued operation.
Yeah. So,
And they can't put that
because there is no information available for us to conclude, so they cannot recognize that section of their business as what? A discontinued operation, because there is no information whether they've located a buyer or whether they have advertised, because they just said they announced it in the press, meaning they announced their decision, not advertising that they want to what? Sell. So it doesn't meet the recognition criteria for IAS 26. However, can they continue to recognize it as an operating segment in this case?
Yes, if they meet the requirement.
If they meet the requirement for what? Operating segment. Now, looking at this aspect, now this question was actually picked from an extract, so it was a whole question and it was too much, so we just picked a session from it. But if we had had the whole session, you would have realized that this holiday aspect is actually it's a big part of their business. So it qualifies to be recognized or can be disclosed as what? An operating segment. It can be disclosed as an operating segment. So yes, it cannot be recognized as a discontinued operation, but they can continue to recognize it as a discontinued, as an operating segment. Okay. The company owns 40% of the ordinary shares of Eurocars, an unquoted company which specializes in the manufacture of aircraft engine and has operations in China and Russia. The investment is accounted for by the equity method, and it is proposed to exclude the company's results from segment assets and revenue. So this one also, how should the company account for it? Under IFRS 8 as well as any other accounting standard. So what other accounting standard can we talk about here? IAS 28. Did we say that? Investment in what? Associate. Okay, because 40% means we do not have what? Control. But if we don't have a control, that doesn't mean that we cannot account for it. So we account for it using the equity method. And that is even stated in the question. But can it also be recognized as an operating segment? Yes, it can be recognized as an operating segment because we are told here again that the business we invest in, they specialize in the manufacturing of what? Aircraft engine, and they have operations in China and in what? Russia. So yes, this one also, they must disclose it as or they must account for it using the equity method as per IAS 28, and they must also what? Disclose it in their segmental disclosures. So that is how we answer this question for 5 marks. For 5 marks. Did you write some of these things I'm saying?
Sure. So did you read my sheets?
I read. I gave you mark. Don't say I didn't
just write, I cannot trust a scene where it goes there. I just like,
Just say, I love you. Some me throw me my Derek. And then Derek, don't you have it there? Hey, it's a make I love you, no one for the person.
Is special.
Oh.
correct, yeah.
She like it all.
Okay, so let's go. C. I think C, I like the way you guys represented it. So I'm not going to talk about it much here. No, I like the way you all represented that. But let's go through it. IFRS 2 requires an entity to recognize share-based payment transaction in its financial statements. These include transactions with the employees or other parties where they are settled in cash, other assets, or equity transactions, equity instruments of the entity. IFRS identifies 3 types of share-based payment transaction and set out the measurement principle and specific requirements for each. I suggest why accounting standard setters felt that there was a need for a standard in this area. We'll share more thoughts. Yes. Why did setters of accounting standard, the International Accounting Standard Board, realize that it should be accounted for? I think Derek, what did you write?
So, entities have been engaging in significant share payment transactions
Okay.
and award schemes.
Okay.
So there was a need, and this has implication on what is classified as equity and liability. So there was a need for
An accounting standard,
to guide
the treatment of these. Okay. Nanaja, what did you say?
Well, I think I want to write here.
Nanaja, what did you say?
I want that so that different tax can be calculated in respect of shares to be exercised in the scheme.
So that. I mean, you started with so that. So you started with so that. Oh, Charlie.
And I also wrote that so that.
So that. That means you like the so that, so that. So as he said, yes, lately entities have been engaged in a lot of transactions that relates to what? Like as they have said here. Okay? Okay? Entities have engaged in transactions with employees. Okay? So you could just bring this whole statement there. Are you getting it? That entities lately have been engaged in transactions with employees or other related party where they are settled either in cash or other assets or equity instrument of the entity. Hence, affects the way those transactions are classified in the financial statement. Therefore, the need for an accounting standard to state how these transactions should be classified and treated in the financial statement. So that's something we could say there. So why? Because entities undertake the transactions and it changes how they are classified and it has an effect on the financial statement. So there should be an accounting standard. Identify and briefly explain the 3 types. Derek, what did you write there?
equity settled, that's share options,
Share options,
then cash settled, share appreciation rights.
share appreciation right, and then what?
Maybe two, so I added myself compound word.
Financial instruments.
Yes, the one that the entity has actually to pay, whether in cash
Yeah,
or share, but I don't know whether.
yeah, that's it. That was a good intuition you used there. You used your intuition, right? Like you just, but you know it because this is under compound. That's under IFRS 9.
That one is correct. So mine was wrong.
What did you write?
I saw sometime the exchange of goods
Exchange of.
and services. So when you read the manual,
Mm-hmm.
there is an exchange of goods to be actual. Therefore, that means
That could also be added. It is this or that one. Now the reason why there is that exchange because what we said the 3 types no cry is I mean an account added out. I'll say transactions with employees or other parties where they are settled in cash or other assets or equity instruments. So that is this share option thing, or this what? Compound financial assets, or the issue about the exchange of what? Services. So you do something for us, but to pay you, we will render some service for you. Or to pay you, we will give you some ownership in our what? Company. That is the reward scheme that you mentioned about when you were raising your points there. So yes, we could raise those points there. Share options where employees or management of the company are given right to what? Buy the share. I think you went ahead to explain that the grant dates can it be, right? So was that where you stated that?
Okay. Is that how they are recognized?
Identify and explain briefly the three types payments recognized by, not how they are recognized.
Yeah, I'm overrated.
Oh, what did I make us say now? No, say confina bar. Me man, no say confina bar. Like, why don't you draw?
I thought I wasn't writing. Like,
no, I saw that confin because I saw that you were writing much than you are supposed to have written. So I thought like, boy, we had when you're lottery and I said, oh, we baba be a mommy and I said. Alright, so the share option, you just explain what is there. The share appreciation right, you explain what is there. Then, either exchange of goods and services or the financial instrument thing, you look at it in relation to that. Because you see, when we issued compound financial instruments, we can either settle it in what? Cash, or settle it in what? Equity. Are you getting the idea? So that is also something that comes about in relation to IFRS. So basically that is it for that. 5 marks there. There you go. The D aspect was about IFRS 15. 5 marks. 3, there has been significant divergence in practice over recognition of revenue, mainly because IFRS have contained limited guidance in certain areas. The International Accounting Standard Board, as a result of the joint project with the US Financial Accounting Standard Board, has issued IFRS 15, Revenue from Contract with Customers. IFRS 15 sets out a 5-step module which applies to revenue earned from a contract with a customer, with limited exceptions regardless of the type of the revenue transaction or the industry. Step 1 in the 5-step module requires the identification of the contract with customers, and it's critical to the purpose of applying the standard. The remaining 4 steps in the standard revenue recognition module are irrelevant if the contract does not fall within the scope of IFRS 15. Required. Discuss the 4 remaining steps which led to the revenue. So you are supposed to discuss. So you all stated. So you were supposed to discuss. So I should discuss. Me, I won't discuss. You know this already. You discuss. How? So what are the 4 remaining? The second one was what? Identify what? The performance obligation. What else? Determine the transaction price, TP. You allocate transaction price to what? Performance obligation using stand-alone price. And then the 5th thing is what? So how are you supposed to answer this question? Identify the performance obligation. You explain what performance obligations are, right? Then you connect it. Is it? Oh, performance obligations are the various activities. Performance obligation is the good or service that the entity will exchange in return for the consideration. But I gave you marks for that.
Oh, give me all of it. What am I going to say, man? But this is the explanation you give the day you were here.
Then determine the transaction price. What is the transaction price? What is the transaction price? It is the
amount that they should receive for the exchange of
of the goods and services, excluding payments made to third parties.
Allocate the transaction price.
Right. So transaction price is allocated to performance obligation using what? The standalone prices. Now the standalone prices refers to how much the entity would have received, okay, or the selling price for each activity or service that is going to be transferred under the contract relating to the performance obligation. Then you recognize revenue as and when. I saw that there you didn't know what to do, right? So that is the idea about that. So 5 marks there, then you go about that. E, the last one. We'll be breaking shortly after this one, something like that. You close. No, we'll be breaking shortly. Then we can finish.
This is our last one. Or
And we'll break and we'll finish. I think you're breaking it to it. No, I could be
So we can continue.
You want to buy?
so that we can close early.
And because for the early day we have to close.
Yeah.
What time can we close?
Because what are we left in? We are left in talking about the question 3. Question 4 is the ratios. I won't go through it. I'll just tell you what you're supposed to do.
You read my investment ratios. Shut down. Yeah, crazy.
I will tell you what you're supposed to do. Then the question 5. I think question 5 there is no issue there. I'll talk about the A, the merchant thing, and the rest. I think you got everything. So you're not supposed to do much. So let's go. E. The directors of AFCO, a public limited company, are reviewing the financial statements of 2 entities, which are acquisition targets, KVAL and Leiden, depending on the school you attended. They have asked for clarification on the treatment of the following financial instruments within the financial statement of the entities. KVAL has 2 classes of shares, A and B. A shares are KVAL's ordinary shares and are currently classified or are currently classed as equity. B shares are not mandatorily redeemable shares but contain a call option allowing KVAL to repurchase them. Listen carefully. They are not mandatorily redeemable, but they contain a call option allowing KVAL to repurchase them. Dividends are payable on the shares if and only if dividends have been paid on the A ordinary shares. The terms of the B shares are such that dividends are payable at the rate equal to that of the A shares. Additionally, KVAL has also issued share options which give the counterparty right to buy a fixed number of its B shares for a fixed amount of $10 million. The contract can be settled only by the issuance of shares for cash by KVAL. What is this? How should this share in KVAL be recognized? Somebody wrote financial assets.
Okay. Who is that person?
This is a compound financial instrument. Can you see that? Additionally, KVAL has also issued share options which give the counterparty, that is the people who we issue the shares to, the right to buy a fixed number of what? 8B shares for a fixed amount of what? $10 million. So that's a compound financial instrument. Because if I issue a loan note, then I'm not mandatorily required to redeem it. On top of that, I'm going to pay you shares based on the share I pay to my other shares. However, I have a contract with you where I've given you a right to buy some amount of shares later on at a fixed amount of money. That means that it's a compound financial instrument.
Is that not also the second option?
The second option. No, it's an option I've given. It's a right you have.
Yes.
Meaning it's a convertible. You may or may not.
But in the first place, from the first one is an equity, right?
No, from the not mandatorily redeemable.
Yes, up to there. You know there is 2 things.
Yes. So that is why it has to be classified as a compound financial instrument, so that we separate it into what? The equity component and the liability component.
Which one is the liability?
Is that?
I'm thinking all is equity.
You thinking all is equity?
Yes.
In what sense?
Because the first one, that one is equity. Because it's not mandatorily redeemable.
But the second statement, additionally, makes it look like it's not solely equity. Because once the person has a right to redeem, has a right to purchase some shares, meaning that even though you are not mandatorily required, you have a contract with the person to come and buy the shares later on. So he can
come to buy shares. When you buy the share, you become a shareholder. That's not a liability. Because you have issued the loan to us. And now you are telling us that at a point in time, we can, you pay us, but when you are paying us, you are going to pay us with shares, isn't it?
Yeah. But look at that statement again. These shares are not mandatorily redeemable shares, but contain a call option allowing Cable to repurchase. So Cable can also redeem.
Yes.
And then the counterparty has, that's the last aspect, also can what? Come and buy a shares.
So I mean, based on that obligation to repurchase,
It's a liability. Are you getting it?
You see, that one is it's not a call option. If it's on the side of the issue.
You. So you can decide.
It's on the side of you.
Yes.
So you can.
I can decide to what? Redeem.
So I because if I have an option that okay, at this point in time I want to give you my money, or at any point in time I can tell you to give me my money. That one is a liability. But when you have the option to buy it back,
That's an equity.
yes.
That's an equity, right?
Yes.
But then, look at the final paragraph. It says, additionally, that is the important thing. Cable has also issued share options. He has issued share option already, which give the counterparty right to buy a fixed. So now I have given you, I have an option to come and redeem. You also have a right to buy 10 million of the shares at a fixed date in the future. Okay? Buy a fixed number of shares of each B shares at a fixed date. That is why it cannot be equity, cannot be a liability, but has to be a compound financial instrument. Derek, I don't know if you get the idea. Because if you just take one side and stand there, you will get it wrong. Does it make sense?
See, the contract can be settled by only issuance. Now there's no cash here.
Where is it?
The last paragraph.
The contract can only be settled only by the issuance of shares for cash by Cable. The contract can only be settled only by the issuer of shares for cash by Cable. So what's the meaning of that?
I give him another paper. It's cash.
Okay, let's make it's a good thing. It's a good thing so that we get the understanding well. So right now, the contract can only be settled by the issuance of shares. By the issuance of shares. So meaning that this contract that we have, it's more or less like a done deal. A done deal in the sense that we can only settle it by what? Issuing shares. Now, so that last paragraph is also important. So if you check, there are three different things in this question. The first aspect, which is letting it to see like, okay, it's an equity. Then the middle aspect, which is also looking at it like something like convertible shares or something like that, an option for the person to buy. But that last aspect, saying that this contract can only be settled by shares for cash. Now when it says share for cash, what does it mean?
They will only pay
the shares instead of giving them cash.
Exactly.
So more or less like this is an equity instrument.
Yeah.
Are you getting the idea? So that's a good observation at the last end. So it's equity instrument.
All of their liability aspects.
So it cannot be because of that last statement. I didn't see that last statement. I didn't pay attention to that. So the contract can be settled only by the issuance of what? Shares. So once we don't have any obligation to repay, you know that is the fundamental thing to classify something as a liability. Once we don't have that obligation to pay, but rather to give them shares, then it's going to be what?
The liability should be on the part of the one issued.
That's right. That's right. So here it's going to be an equity instrument. So B shares should be classified as equity instrument because the shares or the contract is not required to what? Any settlement. Oh, but I give him already. I've given him already. Let's go, Lidan. Lidan has in issue two classes of shares, A shares and B shares. A shares are currently classified as equity. 2 million B shares of nominal value of $1 each are in issue. The B shares are redeemable in 2 years' time at the option of Lidan. Lidan has a choice as to the method of redemption of the B shares. It may either redeem the B shares for cash at their nominal value, or it may issue 1 million A shares in settlement. A shares are currently valued at $10 per share. The lowest price for Lidan A share prices since its formation has been $5 per share. So what do we do here? What do we do here? Redeemable in two years' time, right?
Yes.
At our option.